in this video, I'm going to give you the shortcut you need, because after coaching hundreds of people online through crypto, I figured out exactly what works, what doesn't, and so by the end of this video, you'll know exactly how to crush this cycle right now, especially if you want to do it without any trading at all.
Not bad, Potter.
Because in the last 24 hours of recording this video, a whopping $875 million have been liquidated. And if you're thinking, how is this even possible? Well, this is possible to people that set a so-called stop loss, a limit order, or a leverage trade. There's even a quote that says there's 3 ways to lose money in crypto, which is ladies, liquor, or leverage, right? So without further ado, if we go down, most people are just facing the issue of trying to be smart, while actually the smartest people in crypto are the influencers that are actually lying to them, these so-called affiliated people with an exchange or a project they promote, while actually knowing they're making money whether markets go up, down, or sideways, through saying, hey, I'm affiliated with Binance, use my link, use this code. Even if your family is losing money, they are making money, which is pretty shady if you ask me. Same with those exchanges itself, they fall under that same bracket. And then also the asset managers around the world that are actually buying massive amounts of crypto right now, while you might eventually still be confused about whether crypto or not is the right vehicle for you. So in the next slide here, I just want to tell you how to crush crypto. And I don't think it's about sticking to the news and always thinking about like those World War III scenarios. I think it's about really looking at the data. And the data is suggesting right now that in June 2025, we're again in that accumulation zone where we have been in 2022, 2023, 2024, and again also this year, 2025. The only kind of change in the data was 2021, if I remember correctly, where that accumulation zone happens to be in July, but usually it's around this time, and you can see how usually the cycle kicks off and how altcoins, so coins other than Bitcoin, alternative coins, are shooting up like crazy. Now, this is where we see opportunity, and we're not guessing about whether or not a war is going to allow crypto to grow or whether crypto is going to die. We look at something called total liquidity. Now, this might be new or might not be new to you, but it's the global money around the world that is currently leading Bitcoin up until its next high. And this is interesting. Why? Because if we know that total liquidity is leading Bitcoin, we already know where Bitcoin is heading towards, and we know that when Bitcoin is shooting off like crazy, given that money is already rotating into Ethereum and is going to rotate more into alts as time passes by, we know exactly where the markets are going to go. Now, however, the dollar is inflating right now, and the most main coins are inflating too. So the actual dollar inflation is around an 11% a year. I'm not talking about what CPI shows you, which is a meager 2 to 3% a year. I'm talking about what households are noticing. A lot of people in the States are just mentioning, hey, my costs are going up with 11%. And crypto could even be worse if you don't know what you're doing. Just look at Bitcoin, over 75% of an increase within the market cap, which is virtually inflation. Same if you look at Solana, over 250% of a market cap increase, which is technically inflation. In the short run, it's even been over 20%, right? So this is obviously a longer time span on the screen right now, but if you look at short runs, it's even 20%, which is 9% more than the actual dollar inflation, meaning people try to get fancy with their money and actually just undercut on what inflation is already doing, losing more of their hard-earned money. On the other hand side, Ethereum, one of the main coins out there, already has quite of a huge supply, quite of a huge market cap. But the thing about it is there's something called EIP 1559 that is cutting down on the Ethereum supply. And so like you can see, as opposed to the majority of assets, since 2023, we've seen the flattening of the Ethereum supply. And this happens through that EIP function, which essentially always when transactions happen is cutting down on the gas fees, is burning a fraction of Ethereum. That's also why the top inflows in the last 3 months show to be leading in the Ethereum space, because smart money knows that whenever you keep investing in deflationary assets, you are actually making way much more. And I'm not referring to Ethereum. I guess Ethereum is a very interesting chain, but there's things on top of Ethereum that actually offer way more value. So when Ethereum goes up with like 2 to 3%, you're up a tenfold. And that is the interesting part. So The thing that I just want to tell you is that if you've seen enough at this point of the video, you've learned a thing or two, and you're actually like, hey, this guy knows his stuff, and you want my proven hands-on help with my success coaches in your corner just to see how and if we could help you to crush this cycle, avoid you to lose out of $10,000s of dollars that you usually would just lose if you would stack YouTube videos like this and never act, well, go down below this video, complete the survey, and see how and if we could possibly help you. This goes along with a free complimentary call, which we call a brainstorm call, where we take a look at what you're trying right now, what could be in your way of heading to the next level, and how and if we could actually get you there. And I promise to you that if we cannot help you, we will leave you better than we found you. So there's simply no point in not going down below this video right now, hitting me on pause or putting me on pause, filling out the survey right now and see if you qualify. However, if you want to see something more, I want to tell you what to look for. Inside of crypto, we want to look for small cap deflationary altcoins. What we've seen with Ethereum is basically the cherry on top. We need more. What we need is assets that get scarcer daily. Imagine there's millions of pizzas around the world, and all of a sudden, those pizzas drop like crazy to zero, to maybe the last pizza on earth. What happens is people are hungry, they're craving, they want that pizza, they're gonna pay way much more. It's like an auction with a hungry crowd for a Mona Lisa painting, could be the last one. Everybody wants that painting, so they're overpaying basically just to get that last unit. If you don't believe me, you want something more retail oriented, look at COVID-19, the entire pandemic, where people were just buying toilet paper out of nowhere. This is human behavior that goes to show in crypto as well. So we want to look for assets that get scarcer. These assets get scarcer, not by luck, but by design. Meaning this is not a centralized entity that says now we're getting scarcer whatsoever. It's actual hard-coded money on a blockchain, completely transparent, that has rules in the code that says if something happens, a transaction, a buy order, sell order, whatever, there's a fraction of the money being burned, making the supply a little bit scarcer, increasing the value of what you're holding on to. It's launching at a price floor, meaning there's no venture capitalist or other type of investor money inside before it launches, always starts at the floor. There's public audit reports, developers that are getting paid $15,000 per single vulnerability or mistake they can find in the code. And then there's a public white paper that goes over all of the features, the core things about the project. If projects don't have this, don't waste your time, don't waste your money, don't be there. And then, of course, it's built on Ethereum. Now, the result of this is that you get a so-called DeFi passive income. A DeFi passive income is obtained in two ways, at least from my methodology, which is either through scarcity. The visual I just showed you, if something gets scarcer, the value goes up. It's one big core narrative. Another narrative is through LP. That's liquidity provision. Most of the people inside of crypto, they either buy or sell their assets, right? These create transactions or so-called trades. And in the middle of those trades and transactions, as I told you, there are fees. Ethereum burns fractions of those fees, gets scarcer, flattens out the supply. But also here, if people are trading, buying and selling, you can make a fraction of their fees through something called liquidity provision. This is where you look for a pair of two assets that are strongly correlated and move within a certain price range. As long as they move within the certain price range that you have set, you make yourself fees in Ethereum or other types of assets that you can now use in the real world. And this might be new to you, it might be a repetition to you, but just to give you an idea, this is a student example. I yesterday had a student call, a one-on-one call, and I asked if I could share these values and he was okay with it. The initial value, the initial investment is $9.5K. Whether this is within your budget or it's completely without your budget or outside of your budget, you can see how in 48 hours of time, his position is yielding him $117 for the time being. If we look at his dashboard and if we look at the performance of the position, this means in a day he makes $42, in a week he makes $300, in a month he makes $1.2K, and his actual salary right now actually is $1.5K. So this means if every single 30 days he's taken the fees he's making and he doesn't need it for lifestyle expenses because he still uses his salary, now he can take those fees, reinvest them into this position here at the top, which will make him surpass 10 grand. And then from there, if he consistently keeps reinvesting, at some point in the cycle, he will be able to produce even more than the income that he is making right now. And it will not take this long for him. And this happens in up, down, and sideways markets as long as you are there to consistently monitor your position, which means go to a website, see if you're within range. If you're within range, cool. If you start to get out, maybe rebalance, re-enter, set up the range, and find yourself the strongest pairs. And of course, this is where we make the difference. You could say, if it's all this easy, why is not everybody doing it? Because you need to consistently monitor and find those pairs that are cutting edge right now. However, the minute you find them, my promise to you is that you will be able to take out those Ethereum fees, move them to your Apple Pay card through certain ways, and then you'll be able to actually fund your groceries, your lifestyle, your gym, your Airbnb, your hotels, your travel. As a direct result, your salary will now stack up on your bank account, whether that means you're taking dividends out of your own business or whether that means you're getting paid by a boss. Whatever you make at some point will slowly start to transition into you being able to hold on to that money, have some more savings put aside, money that you can build up, ideally reinvest that into liquid hold positions within this strategy, but also generate fees on the money you already invested. And this to me is the end game, because I got my money working for me and it's giving me back all my necessary time. Time that I can spend around my loved ones, times that I don't need to be in traffic jams, times that I don't need to listen to a boss, times that I don't need to sacrifice to a system that is not longer here to empower human beings, at least in the European Union. And so my rule of thumb for my investors is basically, if your budget is under a 2K, then you want to focus on liquid hold positions. You want a dollar cost average, a fixed percentage of your monthly income into these types of assets. It's going to be cyclical, meaning you need to know when to get in, when to get out. That's why I'm always saying all that matters to Crush Crypto is getting access to the right knowledge and the right guidance at the right time. That's why I've put this survey below. However, if you have over a 2K at certain points, this either means you got in with less than 2K, that position grew, or you by design have more than 2K. Let me just put the line under here so it's visible. Then you could consider liquidity provision and holding as somehow like a breed of both. And then you're going to be able to see, okay, my liquid hold position is growing, my liquidity provision is sprinting, and even then there would be alternatives like yield generation, like lending, like all that good type of stuff. However, I prefer to focus on these two. And so the value engine in liquidity provision, meaning what creates value, what is leading in terms of results, is being in the range. Of course, if you get out of the range towards the top or the bottom, you get one of both assets from the pair, meaning if you didn't do it and you had liquid holds, well then that 50x, that 40x, that 10x, whatever the price performance looked like during the alt season is going to be something you miss out on. So I don't think it's a really valuable option to fully go all in on LP because you're going to miss massive upside growth potential. However, if a fraction of your position is doing LP, then whether markets go up, down, or sideways, you're always going to be making money. However, if you are aware about what I'm sharing right now, so the pair correlation is also crucial. How correlated is one asset to the other? Because if this asset is very steady and the other one is like very aggressive against it, you're going to see how you get very easily out of range. And as you know, if you get out of range, you lose potential and you lose fees. Another one is trading volume. How actively is this asset being traded? One of both or both of them. How much volume is there on a 24-hour timeline? Because if there's more volume, then you're going to make more fees. If it's low volume, even though the correlation is strong enough, you're going to make less money. And then, I guess this is the most important KPI or value engine here, is no divergence loss. Meaning, if opposed to holding, you are now inside of liquidity provision, you see being in a net positive as opposed to holding. Imagine Ethereum is one of those assets within your pair. And now, as opposed to Ethereum, you're up 1,000 to 2,000 to 3,000 to 4,000. Well, then you know there's no divergence loss. And as opposed to the price movement of Ethereum, that was kind of like this for a bit due to geopolitical tensions and all that stuff. Now, still, you were up against the asset that was part of this pair. That's when you know things are going great. Most people don't track this. So even when it seems like they're making fees, they're not having their eyeballs on how much they're either up or down against the actual market price, which is super, super crucial. Thank you so much for taking time to educate yourself today. It was a blessing to record this video for you and those you love around you. I honestly think this is the skill of the century, to weaponize yourself against those unelected bureaucrats that want to completely control you through their so-called central bank digital currency, smart cities, and all that garbage and nonsense. So if you want to learn more, simply click the video that is on screen right now, where I share with you my own self-created passive income tracker. It's like a Google sheet I made that allows you to give certain inputs, get certain outcomes, and better understand what this strategy for you could look like.